These are 10 genius money hacks that I learned on YouTube. Some of them will accelerate your profits, other ones will make you a better investor, and some are just really cool party tricks that you can use to con your friends out of tens of thousands of dollars. But stay till the very end because the last one is by far the most profitable and it will definitely surprise you. Oh, and it's also my favorite. Okay, so let's start with genius money hack number 1, using covered calls to lower your cost basis. Now, this is an option strategy, and forewarning, options are dangerous if you don't know what you're doing. So definitely before you implement any sort of strategy like this, make sure you seek out professional financial advice. But if you do go down the road of using this one, it can lower your cost basis on your investments quite significantly and increase your profits drastically. Okay, so here's how it works. Let's say you own 100 shares in a company and you expect to be invested in that company long term, and you expect the value of those shares to continue to go up. What you can do is sell covered calls, which is an option for somebody to buy the shares off of you at a specified price on a specified date. Now, in this case, because you're selling a covered call, you would be selling the shares at a value that you don't expect the shares to get to in that specified period of time. So let's say the shares are currently valued at $100 and you want to sell a covered call for 3 months down the road at $105, but you don't expect that they'll get to that price. Well, in this case, the buyer of the covered call would pay you a premium for that option to buy those shares. If the shares never hit the strike price, which is that $105, then you get to keep the premium. If they do hit the strike price of $105, then the buyer of those covered calls gets to call in those shares and buy them from you at that price. Now, if this happens, you can always go and rebuy your shares, but there's also other ways to close out an options trade. So make sure you understand how to get in and out of the options trades and what your risks are before you make this trade. But if you do it over the long term and you never have a covered call that hits its strike price, well, you can create quite a bit of income off of shares that you already own, in addition to the regular capital gains and the dividends that you might earn. It's a really awesome way over time to increase the returns from your stock purchases. But again, this is options trading, so you have to know what you're doing, and this is not financial advice. Money hack number 2 is to limit drawdowns. Most people don't realize that the single best way to increase your returns is to limit how much you lose when the stock market turns. And I'll show you a trick on how to do this a little bit later on. But right now, what I want you to understand is exactly how much you have to gain in order to make up for losses and why limiting your losses is so important. So take a look at this chart, for example. Let's say you lose 5% on an investment. In order to regain that 5%, you actually have to gain 5.26%. If you lose 25%, you actually have to gain 33.33%. If you lose 50%, you have to gain 100% back. And if you lose 90%, you actually have to get 900% returns. And this is exactly why people will lose 10 or 15% in their portfolio and then a year or two later, even though the market's gone up 15 or 20%, not be back at even. It's because losses are not proportional to gains, and you have to have significantly bigger upside in order to make up for any downsides. So it is important to have strategies in place when it comes to investing to limit your downside as much as possible. The best way to do this is with a diversified portfolio. Now, speaking of diversified portfolios, this leads us to hack number 3, which is the Ray Dalio all-weather portfolio. This is a portfolio that is designed to work in any type of market conditions. Whether prices are rising, prices are falling, when there's rising growth or falling growth, or any combination of the above. And the reason it works so well is because of the portfolio makeup. It is designed to have components that do well in every type of economy. And because typically one of those components is doing well relative to the others, it tends to make up for a lot of the losses, or in technical terms, a lot of the drawdowns that would happen when the stock market turns. So having a portfolio like this that limits losses and also can be rebalanced on a regular basis, and specifically when the market turns, can actually increase your market returns, even though when you look at the annual expected return, it might be lower than something like simply investing in the S&P 500. Limiting those drawdowns, those big drawdowns, has a significant impact on the overall portfolio value at the end of the day. Oh, and the best way to make up this portfolio is by buying index funds or ETFs that track the following sectors in the following weights: 40% in long-term bonds, 30% in the S&P 500, 15% in intermediate length bonds, 7.5% in gold, and 7.5% in commodities. Now, hack number 4 isn't a hack that's going to earn you a lot of income really quickly, but it is the single most valuable hack you can make when it comes to investing, and that is to invest over the long term. Most people don't know this, but 99% of Warren Buffett's wealth was made after his 50th birthday, and 98% of it was made after his 65th birthday. If at 65 he had retired, we probably wouldn't know who he is. And some people actually think that Warren Buffett has the highest returns in history of any investor, and that's not exactly true. There are other investors that have had significantly higher returns on an annual basis than Warren Buffett. But the one thing that Buffett has that they don't is time in the market. And that should be a lesson to all of us that we need more time in the market in order to make more money. So the best thing we can do is start at as early an age as possible, which means if you haven't started, you need to start right now. And to better illustrate why, check out money hack number 5. Now, this is a really cool way to dupe your buddies out of a ton of money. Or if you're not that good of a golfer, you actually might lose a lot of money as well. But here's the trick. So you roll up to the golf course and you suggest to your buddies, hey, I'll give you 2 options for a bet today. We can either play for $1,000 or we can play for 10 cents and it doubles every hole. Well, most of your buddies, especially if they're cheap, are going to pick the 10-cent bet. Or they might pick it because they're really good golfers and they know that you're about to lose a ton of money. But here's how the bet works. The first hole is worth 10 cents. The second hole is worth 20. The third hole is worth 40. And by the time you get to the 6th hole, you're playing for $3.20. Still doesn't seem like it's a bet for a large sum of money. But by the time you got to the 12th hole, all of a sudden you're playing for $204.80. Now things are getting a little bit more tense and the stakes are getting significantly higher. But they are nowhere close to as high as they're going to get. By the 15th hole, you're playing for $1,600. By the 16th hole, you're up to $3,200. By the 17th hole, you're playing for $6,500. And by hole 18, you're playing for $13,107.20. Meaning that bet that started as 10 cents has turned into a significant sum of money. Depending on how good of a golfer you are, or how lucky you were that day, you probably would have been better off playing for that $1,000. Now, this is not only a really good trick to play on people, it's also a really good way of showing people what compound interest can do. And while we aren't typically doubling our investments every single year, the point is that all of the magic happens at the end. So even though in the beginning it may seem like we're playing for pennies, the real payoff is at the end. And if we choose not to participate early on and think, oh, what difference will it make? It's no big deal. Well, it is a big deal. Because let's say, for example, you chose only to play 12 holes instead of 18. Well, as you can see, a significant amount of the potential returns are pretty much wiped out. This is why it's so important to invest early, and this is why 99% of Warren Buffett's wealth was made after the age of 50. It's because he had more time in the market than anybody else. So the lesson here is we all need to focus on getting as much time in the market as possible. Okay, so our 6th investing hack is to spend at least 15 minutes a day reading books on money. This will improve our financial literacy immensely. And let's call a spade here. The only person that is responsible for your money is you. The amount that you have when it comes time to retire, whether or not you are in debt, and all of the things that come along with money are 100% your fault. Which means that it's your responsibility to learn as much about money so that you don't find yourself in a really bad situation, or more importantly, so that you can find yourself in a really good situation one day when you have a whole ton of it. After 30 days of just reading 15 minutes per day about money, you'll have 7.5 hours worth of education, and after a year, you'll have over 90 hours worth of financial education, which will put you well ahead of 99.9% of people. Okay, investing hack number 7 is the rule of 72. Investing hack number 7, rule 72, makes sense. So here's how it works. This is the way of determining how long it will take for your money to double. All you do is divide your expected return into 72. So in the case of the all-weather portfolio, we expect that it will return about 7% per year. Divide that into 72, and that means our money will double every 10 years if we do nothing else other than just leave it alone. Need to double your money faster? You need higher returns. Want to get it done in 7 years? You need a 10% return. Money hack number 8 is the 4% rule. 4% is about the amount of money that you can withdraw from your investments every single year without running the risk of running out of money. This is a really good rule of thumb for people to know when they are retiring. If you know that withdrawing 4% per year will give you a 30-year window before you run out of money, that gives you a pretty good prediction of how much money you need in order to retire. Need $40,000 a year for the next 30 years? You need to have $1 million. Need $80,000 a year for the next 30 years? You need to have 2. Money hack number 9 helps you determine if you are on track to retire. And it's actually a series of rules. So if you want to know if you're on track to retire by the age of 35, you need to have 2 times your annual income saved. By age 40, you need to have 3 times your annual income saved. By age 50, you need to have 6 times your annual income saved. And by age 60, you need to have 8 times your annual income saved. If you're on track with those numbers, then you should have more than enough money when it comes time to retire. And if you're behind, you probably got some work to do. Investing hack number 10 is to use trailing stop losses. Remember at the beginning, we talked about not losing money? Well, it turns out the number one rule of investing, according to Warren Buffett, is to not lose money. The number two rule, by the way, is to never forget rule number one. And a great way to limit the amount that you lose is by using trailing stop losses. This is where you can set a percentage decline off the highest value that the stock has ever been in order to automatically liquidate the shares. This comes in handy when there's a turn in the stock market and you want to get rid of shares quickly so that you can both minimize your losses and then rebalance your portfolio and buy back in at a lower price. But be careful, you want to make sure that you do buy back in and that you don't miss any of the inevitable up days that are coming down the road. Oh, and investing hack number 11, this one is a bonus. $1 saved is $2 earned. So in other words, for every dollar that you save, you earn $2, which is a 100% return. The reason for this is because a dollar saved is an after-tax dollar. In order to earn that dollar, you would actually have to earn $2 before taxes. So the single best investment that you can make is in saving money, whether that's buying bulk goods, only buying things on sale, or buying things that you know you will need at a cheaper value in today's prices rather than buying it down the road. This is the single best investing hack you will ever make. And if you can save several $1,000s a year by doing it, that's several $1,000s that you have to invest and that will ultimately lead you to a significantly better financial future. There's a reason why the most frugal people, think about Warren Buffett, for example, have the most money. And it's because those dollars saved turned into significant amounts of dollars earned down the road. Oh, and if you want to see another video on 100 money hacks that I learned from YouTube that is absolutely awesome, make sure you check out this one right here.